The following is a presentation of TFNN.
All right, welcome everybody. My name is Don Kaufman, and welcome to the Options Hour here on TFNN. This is the Options Show that, of course, call in with your questions. So if you've got them, call in, whether it's options, stock, futures related. I'm here to answer your questions. And, we could definitely use a couple of callers right off the bat. So give us a call, 877-927-6648. We'll give a quick recap of the markets, talk a little bit about options in general here today, and kind of get things rolling all together. So with that, obviously, E-mini S&P 500 futures up 375. Okay, NASDAQ futures down 2.25. Dow futures up 31. Of course, our VIX is off pretty significantly here. VIX is off about 87 cents today, after actually being kind of flat to up a little bit in the morning here. Oil, really not much to speak of, off of kind of its highs here. And, of course, bonds are kind of flat on the day. So, this is a pretty interesting day that, once again, we're meandering in the markets. Volume is also relatively low, and we'll talk about that a little bit as we go along. So, markets have rallied right back up to very, very close to their recent highs here. As you guys well know, if you listen to me week after week, I'm a little bit of a short. And in a market like this right now, big-time contrarian, I look at this and say, got to get short. Now, I'm not here to talk about, directional trading per se. I'm not a big market technician. I'm definitely more of a contrarian trader. And, of course, I utilize defined risk option strategies to get into that contrarian perspective. And that basically means not necessarily being bearish and everybody else is bullish, but selling, for instance, right now, selling out-of-the-money call spreads in major index products to get short this marketplace, or buying slightly out-of-the-money put calendars. It's buying an out-of-the-money put calendar in a major index product not only gets you short the market, but it also gets you long volatility, which could be an interesting play right now. But it looks like, this market is not only going to touch these highs, these recent highs, but we could even exceed them very, very slightly. So if you are short right now, hang in there. It's been kind of a rough ride. Also take a look at the VIX. So I'll click on the VIX here really quick and pull that up, of course, kind of zoom in a little bit. The VIX is right back down also to its kind of its recent lows there in the 16 handle. We've even dropped down as low as 15 recently. But again, the VIX off almost a full point now, down to 1650. And with that, we would like for you to give us a call and talk a little bit about options. And again, every week in between calls, I kind of have a theme that I discuss here in regards to options. But today, we're going to basically take as many of your calls as we possibly can. So give us a call, 877-927-6648, and really call with any kind of option-related question. A lot of the times lately, people have been talking about double and inverse triple ETFs. A lot of questions have come in lately in regards to futures and how to utilize futures more effectively, or options on futures, and really understanding that all products relate to one another has been a big topic of conversation lately. So, somebody there in the chat room is like, trading what you think. So, trade what you think. No problem with that whatsoever, which I like. Anyway, back over to the trade tab. I'm going to pull up the spiders, talk a little bit about the markets again in general here as of late, and then jump into a little bit of talk about options as we kind of move forward here. Again, every week we kind of discuss something around some of the calls that come in. And, lately I've been talking a little bit about criteria for setting up some of your trades, that being which options do you buy or sell, how far out in time do you go, specifically which strikes do you utilize. Is it in the money? Is it out of the money? Is it at the money? And that's really kind of where I'm headed again today, because more often than not, a ton of callers that call in, or, people are emailing me. I literally get hundreds of emails a week at, of course, my ThinkorSwim address. And, with that, most of the emails are in regards to, I picked the market direction accurately, but I still lost money. And that's really going to be a little bit of the theme today is I picked market direction accurately, but I still lost money because I traded options. And it's really going to be utilizing the right option strategy. So that's not only going to wrap around criteria today, but we're also going to talk a little bit about, obviously, probabilities. And, this is something I've covered and hammered week after week after week, but every week I kind of take it in a different direction to a different level. So, bear with me as I go along today. And, of course, if you've got an option strategy, or better yet, maybe you've got an equity that you're thinking about trading, like you want to put a position right now on Netflix, or you want to put a position on Google. Google's actually getting whacked a little bit today. Google's down about $16. Obviously, percentage-wise, that isn't that huge. But if you've got an equity or index product that you want to trade, all right, whether it be bullish, bearish, neutral, give us a call and let's see if we can live on air today kind of construct an option strategy around what you're thinking. And we'll talk about probabilities, we'll talk about probability versus profit, and we'll really kind of dissect some of your individual trades. That being said, really feel free to give us a call for anything. Why? Because this is a call-in show, and you're supposed to call in. So give us a call, 877-927-6648. Like you guys haven't heard that number about 500 times already today. Anyway, with that, also feel free to chat in over there to the Tiger Den. For those of you guys that are listening, I am watching, I am reading. I've been doing this for a while, so I like to talk and read at the exact same time. Anyway, with that, kind of taking a look at the spiders now, up about 51 cents on the day. Yeah, once again, we're kind of rallying slowly and painfully to the upside. With that, before we jump into anything else, let's take a first caller, and if you're listening, you need to call in as well. So I think I've got on the line John from Philly. Question about the TBT, and I trade the TBT quite heavily. So, John, you there?
I am. So, Don, you're my expert. Terrific.
You know what? I've been long TBT for quite a while. I've actually long the underlying, which is kind of a dangerous thing to do because this is a double inverse. So yes. I'll talk about that in a minute, though. What's your question on there?
Don, I'm looking at this chart, studying the bonds. I've seen TBT has gone sideways, Don, for literally 4 months now, maybe even 5.
Yep.
I have no position. Frankly, I don't know. I have no clue which way it's going to go next. But you're the pro. And by the way, I'm in the den so I can see your screen, and you're looking at all those options. My question, Don, is there any option strategy that occurs to you, and what specific options might you look into in speculating that this dead pattern turns into either a rally or a decline? And frankly, I don't know which.
So, when I look at TBT, obviously TBT is the inverse of the TLT. It's a double inverse of the TLT. The other things that you always want to glance at, whenever you talk about TBT and TLT is basically it's set up as an ETF, but it's set up as a 20-year ETF bond, okay? So what I have quoted on my screen as well is I have both bonds and notes, the actual futures contracts. So I have /ZN and I have /ZB. ZN is the 10-year note. ZB is the 30-year bond. So I actually look at the vast majority of those. And in this time, and I'll take a directional stance here. Fed fund futures rates are sitting between 0 and 0.25. Okay, all of us agree that sooner or later interest rates are going to rise. Now, that doesn't necessarily mean that these longer-term rates are going to rise, but ultimately, I'm wanting to get long interest rates, meaning I want to get long TBT. Or instead of just getting, long TBT, which is long interest rates, you could get short some of these bonds or some of these notes. So they're all the exact same trade. Ultimately, I believe TBT is going to appreciate up. The problem is if you want to own TBT, obviously, it's a, being a $37 stock, it's going to tie up some capital. But if you own TBT, you got to go out and sell some calls or something against it because it's a double inverse ETF. There's a slight decay rate associated with the physical underlying, which can kind of hurt you. Now, if you wanted to create an option strategy around this. There's a few things you can do on TBT. The first thing that comes to mind is, did you want to own TBT, John? Do you actually want to own the underlying or just trade the options?
You know, I'm ambivalent, either or.
Okay, so if you wanted to, I'll go through a couple of things. If you wanted to actually go out and own the stock, sell puts, okay? Sell puts to own the stock. And people are like, oh, man, selling puts is a scary thing. If I sell those 36 puts, that stock could go to 26. It's not likely. And the reason it's not likely is we're not talking about a stock here. We're actually talking about, okay, bonds. And the bonds are not going to be as heavily volatile as would, for instance, a commodity product or, you know, the S&P 500 of futures. So the volatility of this is going to be measurable, and selling a put in here gives you a decent probability. So if I come over here and drop in one of my information layouts, probability, selling a 36 put for May brings in about 75 cents, and it's got about 65% chance that trade expires worthless. Okay,
well, now that you mentioned that, Don, selling the put and actually just accept having that stock, having TBT put to you if it falls through the strike, I like that idea. Question. Yeah. If you sell for every TBT, that May 36 that you sell at 75,
yep.
You get credited, how much what's the capital, what's the margin or capital requirement in your account for each one of those?
All right, great. So for the most part, if you're what they call Reg T margin here, all right, so with Reg T margin, I'm actually going to pull up just literally selling one put in my portfolio right now. The max loss, obviously, you can see the max loss, max profit, the buying power effect. All right, the buying power effect is critical. On one contract, it's $1,363. Okay, so that's the reduction in buying power, and that's one of the most critical aspects is what amount of the cash in your account or capital in your account it's going to eat, and it's about $1,400.
Yeah, okay, gotcha. Okay, great.
For one contract.
Yep.
Now, that's one reality. Now, if you never wanted to own the stock, you could go out and you could actually sell a put spread. Yes. And selling a put spread is going out and selling a vertical like the 36 or, say, the 37, 35 put spread for 66 cents. Okay, that's pretty straightforward, selling the May 37, 35 put spread. One other scenario, it's got a little bit of a higher risk associated with it, a little bit of a lower probability, but this could pay out, is basically getting synthetically long by using a vertical spread. It's buying a slightly in-the-money vertical spread, buying a 36 call and turning around and like selling like a 39 call for $1.43. Now, this is an interesting trade because if you're buying the 36, 39 spread, it's a $3 wide spread for basically, let's call it, I know it's $1.44, but you call it about $1.50. This trade is risking $1.50 to be able to make $1.50. So it's like a 1-to-1 risk-reward ratio with right around a 50-50, probability of success here. This trade tends to be a little bit more aggressive. Okay, if you're buying them in the money spread. The reason I'm buying an in the money spread though is there's very little extrinsic or time value associated with this trade. Okay, or again, if you're a little less aggressive, sell it out of the money put spread. Or if you want to own the stock, go out and sell puts to get long that stock.
Terrific.
Okay? Yeah, that's pretty much a couple of scenarios for you.
Thanks for the rundown, Don. It's really helpful.
All right, thanks a lot for calling in there, Joe.
Thanks.
All right, John from Philly. You don't want to get anybody's name wrong from Philly. Okay, so with that, we've got another caller here. We've got Greg from Boston's got a question about SLV. Greg, are you there?
Yes, how are you, Don?
Good. So SLV. So honestly, I don't really trade this that much, but I follow it a lot because Tom Sosnoff, Steve Quirk, Joe Kinahan, I work with, are all on this bandwagon right now. So what are you thinking? What are you looking at?
I was wondering which would be the better options because I've been watching SLV and have traded in the past on TOS. Now I find that SLW tends to swing a lot more than SLV.
Okay.
But the problem is that with SLV I have weekly options, so it's easier to put spreads on a weekly as opposed to SLW, which gives only the regular options.
Correct. And you know what? I actually agree with you 100% in there. The liquidity is a little bit better in SLV as well. So, and SLV obviously is going to track silver, okay, a little bit better than SLW. So from a tracking perspective, I mean, you're trading, okay, that particular metal here. And it's not a futures product. And the other thing is you could consider trading the physical future, but I have no problem with SLV. If you're okay with the margin and everything there, this is a good product to trade. I mean, you're looking at penny-wide markets. You've got decent volume and open interest on here. It's actually fantastic for
easy to get in and out.
Yeah. I'm sorry?
Easy to get in and out.
Yeah, that's and that's all you can ask for. And again, SLW is not horrible, but from a product perspective, if I just had no binding to the actual product, meaning that I didn't care one way or the other which one I was going to trade, I would probably go with SLV. And those weeklies also make it. It's really attractive. Okay, so I got a question for you. You getting long here, or are you getting short? What do you think?
At this time, I think that SLV is kind of getting really high. So I have actually got onto one side of the trade, trying to go long. Yeah. But I'm ready to find that if it's turning the wrong way, to leg into the other side and make it a short trade.
Yeah, I like it. And the reason I asked that is because basically I got everybody in my office screaming at me to get short silver, and I'm like, I don't really know. It's not something I trade very often, so I'm like, I don't really know. I'm kind of weird. Like, I stick to the products that I trade, and I never go outside them. I mean, I trade like oil, so that's it's a commodity product. I've never gotten into some of the metals before, like gold, silver. I'm like, I don't know about that yet. But the more callers like yourself that are talking to me about it, the more convinced I may have to get short silver here. And it's looking at a chart on this thing. Man, this has been like a runaway train, and I got to tell you, yes. So I'm a huge contrarian. Getting short right here for me, would be the only move. Like I couldn't get long an underlying that's had an up move like this. I mean, you just don't see stuff like this very often, and everybody's trend following. The interesting thing about this that I'm looking at, and I'm not a big market technician, so the volume is starting to drop off a little bit on this up move. And today we're at the high today.
Yes.
Yeah.
Great. Thanks a lot.
All right. Thank you for giving us a call today. All right. So with that, if you're listening, again, you guys want to talk about any specific underlying out there, and whether you're bullish, bearish, neutral, you want us to help create an option trade, it's kind of fun. So give us a call at 877-927-6648. With that, we have a John from Philadelphia. We already had a John from Philadelphia, but apparently this is a different John from Philadelphia. So are you still with us there, John?
I am, Don. How you doing?
Good. How's it going?
Good, thanks. I had more of a theoretical question about the likelihood of an option expiring in the money at expiration. I've heard you say that you need to take into account the option premium, not only the deltas. So if you want, I'm using, for example, the May SPY options.
Sure. I'm looking at them right now.
Okay. The 137 calls, for instance, are trading at roughly $1 and carry a 30 delta. And I've heard you say that to get an approximation of the likelihood of whether the 137 will finish in the money, you really need to add that premium. So, and therefore, add $1, look at the 138 strike.
Well, that's if you were buying the 137.
Right.
So what I'm basically saying is probability basically is on that particular strike. So if you were to buy the 137s, you don't need us at 137. You need us at 137 plus the $1 you paid. So to be able to break even, your break-even point is really right. It's 138.
I'm wondering if by the same logic, would the same apply to in the money options, like the 124s, for instance, trading at roughly $10, $10.50.
100%, and it does, because when you look at those deep in the money options, and I'll open up a couple of strikes here, and I'll look at the 124s with you. So they're 1042, and there's basically an 84 delta associated with them. That doesn't mean you have an 84% chance of making money. That means that these have about an 84% chance of falling in the money. For you to be able to make money, though, you're going to need us to fall at basically 124 plus the 1050, which takes us to about 134 and change. So there's about a 45% probability of cresting above that. Basically what it says is that when you're buying options, okay, the probability of success is less than 50%. Okay, so if there's ever time value associated with that option, and you're going to get charged time value unless you're buying deep in the money, even these 124s have a little bit of time value on them. Whenever there's time value associated with it, you're going to have a definitive move in your direction, meaning if you buy an option and you're bullish, you buy a call and you're bullish, that stock is going to have to move the direction you intended it to be able to make money. That right there tells you that there's less than a 50% probability of that particular move happening. And that's looking at a pure statistic model of this. It's not to say that, you might be really good at picking direction, meaning that you might be right more than 50% of the time. But if you looked at a pure statistic model of this, people are right about half the time in the marketplace and think, God, it's going to be really hard to make money in this business, only being right about, 50% of the time. Well, if you're selling out of the money premium, you don't even have to be right 50% of the time. So the odds are actually a little bit in your favor. The only difference is when you buy options, the payouts are really good when you're right. When you sell options, okay, the payouts are not as good, meaning that basically it's kind of, risk 2 to be able to make 1, all right, versus risk 1 to be able to make 2. That's really what you're always kind of fighting when you're buying versus selling options.
Yeah, I'm with you. I just always wondered if it applied to deep in the monies because, like in the example I used, the 124s, there's a huge difference in delta between, the 124s at 85 delta and the roughly 135 or 134 and a half, which would be, like you said, about 45 delta. I mean, it's a huge differential.
Right, absolutely. No, totally agree. But that delta, again, is the probability of it falling in the money by expiration. So basically the 124s have roughly about an 85% probability of falling in the money by expiration. And that's looking at, it's basically those probabilities are off of the price right now. And you've got to assume that the price is pretty deadly accurate right now on the spiders because there's 9 exchanges making markets in there. So you got to assume, for all intensive purposes, it's an 85% probability of it falling in the money. But because it falls in the money doesn't mean that you are going to make money. And that's really kind of the way to think about it is in the money and you making money are two very different aspects in this business. If you're looking at strategies just to get long the spiders, cheap ways to get long the spiders, take a look at those weeklies too. Those weeklies are fantastic because there's the in the monies will cost you a lot less, have a lot less risk, and they've got really high deltas associated with them. So if you're really hell-bent on picking a direction in the market, take a look at weeklies for a short-term trade. Or if you really want to get directional in nature, just use the ES future. I like E-mini S&P 500 futures. I like all the products, the Chicago Mercantile Exchange. I'm a big fan of futures. So, it's always something to think about. The only problem with futures is they're not defined risk, and it can get real ugly really, really quick if you're on the wrong side of those things. You been to that level yet?
Just trying to get there. I haven't traded them yet.
Yeah, I mean, I always call futures chocolate-covered hand grenades because they're really great. They look great until they blow up on you.
Right.
It's an interesting business, but again, if you're directional, bias is one way or the other short term. Those weekly options could suffice very, very nicely. And if you don't mind, I like selling out of the money call spreads and put spreads. That's how I get directional. I like, for instance, if I were looking at the spiders right now and I wanted to get bearish, I'd go jump right to a 30 or 40 delta option. I'm clicking right now on the 136 calls. I'll right-click, drag to sell down to vertical. I'll sell a 136, 138 spread for a 75-cent credit. I like it because, for the most part, it gets me short and it gives me a buffer. I mean, I don't really lose money in this trade to 136.75. I can't say I can't go wrong. Of course I could go wrong, but when I am wrong, at least it gives me a little bit of breathing room. The payout's not huge. It's 75 cents. But the probability of success in the trade is about 65%. So that's the kind of stuff that I like to do. And that's if I want to get a little bit bearish. But if I've got a lot of conviction and I think we're headed down now, I might just get short a future. So you got any follow up on that one?
Not for me, Don. Thanks for talking me through that. Appreciate it.
No problem. All right. Thank you very much, John from Philly, or should I say the other John from Philly. All right. So with that, wow, a couple of big callers right off the bat. If you guys are sitting home again, you want to talk any option strategy, give us a call. And again, whether you're bullish, bearish, doesn't matter what the product. In fact, I love it. If you just call us and talk to us about a product that you're thinking about trading. We get that a lot. I'll actually look at the product even if I don't know. When I say product, whether it's a stock, an option, a future, if it's some equity that we've never heard of called Joe's Tree Cutting Service, we'll take a look at it. We'll see if we can figure out an option trade. Listen, I've got no problem whatsoever telling you don't trade it. You know, if the liquidity is not there, you know, hey, you gotta basically take it with a grain of salt and move on to another product over there. But give us a call today at 877-927-6648 if you would like to talk to us about anything over here. With that, I'm actually going to go and I'm kind of digging through over here some of the chat questions. So somebody's actually, you know, chatting in over here. I'm kind of reading a few things. All right. So feel free to chat in because I'm actually reading the chat room right now and apologize. I didn't get too much time here to kind of look back. You know what? Somebody's actually asking, Big Bill said, please explain how come you end up with 65% on that particular spread. So, you know, a moment ago here, I was in the spider. So thank you, Big Bill, for talking to us about that. And feel free to follow up questions there in the chat room because I am now reading in the Tiger's Den. And if you don't want to chat them in, call us because the callers get really exciting. So 877-927-6648. Let me explain a little bit about the 65%. Anytime I look at an option chain, I mean, literally the first thing I do when I open an option chain is I open up the chain that I'm even interested in. Okay, April, to me, April's burned. April's only got 10 days left. If I'm looking at April right now, it's because I'm closing out trades. You know, granted, you could possibly trade some of the weekly options out there. That's neither here nor there. I mean, weekly option strategies, fantastic. We love it. But right now I'm looking at core strategies that I've got on, so immediately I default myself to May. There's 45 days left till expiration. The next thing I do is I always have delta up on my option chain. All right, I've got to have delta. It's what I look at. It's really, I use delta the same way I use probability. So delta, you know, there's a couple definitions for delta. Delta, the rate of change of the option for every dollar move in the stock. Come on, everybody's heard that definition out there. That definition is not necessarily wrong. That's the primary definition of delta. It's the rate of change of the option for every dollar move in the underlying stock. The bottom line is delta. The delta of the option I have highlighted right now, the delta is basically 36 cents. So what that means is when this stock moves up or down $1, it means this option is going to be affected by 36 cents for a $1 move in the underlying. But the other definition for delta, and this is a loose definition, the other definition is delta is loosely the probability of the option being in the money, by 1 penny or more come expiration. So, somebody asked me, how did I derive 65%? Well, the one thing I can do is take the other side of delta. When I say the other side, this option has about a 35% chance of falling in the money. Therefore, it's going to have about a 65% probability of falling out of the money. And if I turn around and I right-click on this 36 and I go to sell vertical, this is kind of a fun exercise to go through, sell vertical. Now, this is a $1 wide spread here for, let's just call it a 40-cent credit. You guys are following along on the screen show. What that means, dollar-wide spread for a 40-cent credit, that means there's 60 cents of definitive risk. To figure out the rough probability of success in the trade, just a rough probability, take the risk in the trade. The definitive risk in the trade is 60 cents. Divide it by the width of the spread. Comes out to about a 60% probability of success on this trade. Now, that's about a 60% probability of this trade making 1 penny or more. And, of course, you could also do this with a $2 wide spread. If I do a $2 wide spread, let's say for a 75-cent credit, that would be what? What's the risk in the spread? Well, it's 75-cent credit. Now it's $2 wide spread. Basically, I've got $1.25 of risk. Take $1.25 divided by $2 comes out to about 67.5%. Boom. That's a great way to be able to figure out probability in a nutshell. The other thing you can do is, the bottom line is this. If you don't want to figure out probability the way I just did it, because I know that a lot of you, I just whipped through that in about 3 seconds. But, the easiest way to figure out probability, sell crap that has between a 30 and 40 delta. Now, crap is not, the that much of a technical term. When I say that, I'm saying sell out-of-the-money junk options that have between a 30 and 40 delta. It's a great way to give yourself between about a 60 to 70% probability of the option that you're selling is expiring worthless out there. So with that, let's take a couple of more callers over here. It looks like we got Paul from Boston about spread trades. Are you there, Paul from Boston?
I am, Don. Thanks.
Yeah. Sorry for keeping you on hold over there. Just wanted to explain that to a couple of the guys over in the chat room. So what do you got for us?
Absolutely. Where I am looking to, I guess, effectively straddle or hedge the direction of, say, GLD, and I was looking at buying 141s on the put side and buying 142s on the call side, and my bias is more to the downside. Is there a drop-down descriptive for that purchase that allows me to overweight the downside, say take 10 options on the down and 5 on the upside?
So I got a quick question. Do you have a position on there right now, or you're long or short this underlying?
I do not. No position.
Okay. So you know what? One of the easiest ways, rather than try to set up like a straddle like you're doing, I understand you're kind of hedging off a little bit. The easiest way to do it is just to use a spread. I mean, ultimately, I probably wouldn't mess with buying a bunch of out-of-the-money puts and buying a bunch of out-of-the-money calls.
All right.
Ultimately, because both of those then are going to decay against you if we stay in a relative range.
Sure.
But, for example, if you're bearish right now, but you want to give yourself a little bit of breathing room, just like we talked about, you come out, for instance, to the 144. And I'm actually going to give you an interesting logic here.
Yep.
You come out to the 144 calls. They're about a 38 delta. You can right-click on them. Just simply go sell vertical. You could sell, for instance, a 144, 146 spread for like a 60-cent credit. Now, that's not a huge credit, okay, but it's a credit, about a 60-cent credit. The trade then has about $1.40 of risk. The probability, okay, it's a $2 wide spread. You collect 60 cents up front. Probability is about 70% of making some money in here. But you only collect 60 cents. Now, that's kind of one scenario that you can take, and that's how easy it is to get short this. And if you think about it, you know, for what you were trying to create, that's the easiest, cleanest way with not a huge amount of risk and also a decent probability of success. So does that one make sense to you?
It does.
Okay. So we'll take it a step further. Go ahead.
But I'm just on the obviously on the speculation that there might be a substantial downward move, and you'd like to be able to be in a position to take advantage of that.
Okay. So I'm going to give you a slight variation then. If you want to be a little bit more aggressive, okay, we're talking about a little bit more aggressive, we could actually buy some type of in-the-money put spread or slightly in-the-money put spread and give ourselves like a 1-to-1 risk-reward ratio, and then we'll work from there. I mean, there's a couple different things we can do.
Right.
So I'm going to go ahead and I'm going to right-click now on like the 143s, go down to buy vertical, buy the 143, let's look at a 139 spread here for about $1.90. Now this spread, for the most part, it's a $4 wide spread trading for about $1.90. You're risking about $2 in the spread to make about $2. Okay, once again, it's defined risk. It's got a decent probability of success associated with it. It's about a 50-50 shot, and it's also limiting the amount of extrinsic premium that you're paying.
Great.
So it's another scenario, and that's risk one to make one. That's basically getting you synthetically short stock. And I got one last idea for you, and this one may actually be kind of good. You okay with buying an in-the-money spread? You familiar with those?
Yes.
One other spread type. This does not give you unlimited downside, but this gives you actually one of the best payouts. Okay, the probability of the trade I'm about to theorize is a little bit lower, but the trade itself gives you one of the absolute best payouts, and that is utilizing a calendar spread, maybe at like the 137 level. Just go buy calendar. And this particular calendar spread right now, a 137 calendar spread is trading for about 75 cents.
Okay.
And this could have a nice payout. This could actually have a 1 to 2 payout. And that is going to be better than going out for sure than just buying puts and hoping that we move down. The other thing is you can use a combination of these. You know, buy an in-the-money put spread, utilize a calendar spread, and sell the call spread. It's just a nice blend, a mix to fix your allocation over there.
Great.
But everything I just said is I would use 10 times over just going out and buying puts right now.
Great. All right.
Yeah. Yeah, so if you're familiar with calendar spreads, go to it. If not, we're actually talking about calendar spreads. I've got a chat later in the week on ThinkorSwim. We'll probably talk a little bit about calendar spreads on there. So by all means, if you ever want to talk calendar spreads, shoot me an email also.
All right, fabulous.
Yeah, thanks for giving us a call.
Thank you, Don.
All right. So we're going to jump right to the next caller because we've got a couple of callers in queue right now. We've got Dennis from New Rochelle, New York, talking about option and selecting options, I believe. So you there, Dennis?
Yes, I'm here.
Yeah.
I was wondering. Good. I was wondering what's the best probability type of option for you to do where you have a better risk or better reward ratio.
All right. You're looking. You basically want to do like a 1-to-2 payout, so you want to risk one to be able to make two.
Okay.
Is that what you're looking for? You want to? What's interesting about
the term, whether it's straddle or a call spread, or
right. So I'll kind of give you the good, the bad, and the ugly over here. And what this is basically if you want a trade that has a high probability of success. So let's say you want a trade that has a 70% chance of success. That basically means that you're approximately risking 2 to be able to make 1. So if any trade that you find that has a 70% probability of success associated with it, roughly risks approximately $2 to be able to make $1. Now, conversely, you can do trades that risk $1 to be able to make $2. But then that trade only has about a 33% probability of being able to make money. Options are really a very simple model that way. High probability means higher risk. Lower probability means a greater payout, but it's got a lower probability of success associated with it. So when you talk about a straddle is buying a call, an at-the-money call, and buying an at-the-money put. All right. Although it sounds reasonable, it has a very low probability of success associated with a straddle. If you were talking about selling an out-of-the-money call spread, an out-of-the-money call spread has a higher probability associated with it, but it's also going to have a little bit more risk associated with it. So does that kind of make sense to you a little bit, Dennis?
Yes.
Yeah, so, I mean, everything's a trade-off. So do you have any specific trades you're looking at right now you want us to talk about or go through?
Yeah. With respect to, like, current, how would you apply that to, like, do you think that the dollar, the U.S. dollar is going to go down? Is there any way you could apply it to currency futures, or would it be better with Forex?
You know what? So there are some options that are popping up and some Forex items out there, but you would be better off trading products in that, you know what, God, it's been a long time since I've looked at this. Like, I think it's XDE, is it? Oh, man, here's actually the euros themselves. So XDE, and if you look at XDE, the liquidity is not great, right? But there's a couple of ETFs that relate to some currency products out there. And so, you know, there's a few of them, like XDE is just one that came up to my, that's the first thing that kind of came to mind. But if you wanted to get, like, you know, short euro, long the dollar, you could definitely create option strategies there in some of these ETF products, and you'd be best off doing that because although there's some options right now popping up in, like, the currency markets, the liquidity there is by no means great. And I really think that in this product, in this case, I would probably stick with equity ETFs and options on those ETFs. So anything you had in mind over there, or are you actually familiar with the XDE?
Yeah, well, I was thinking of, the XDE.
Yeah, so you could just get short the euro. Getting short the euro, for the most part, is getting long U.S. dollars. For the most part. I mean, there's a couple of different scenarios that we could do here. And, I love it. You brought up a product that, I got to tell you, to be honest, I haven't looked at this in a really long time. So this is something you can definitely, take a look at. And I'm not sure there's huge option volume on here. There's, like, nothing going on. But the markets are not absolutely horrific on here. There's not much going on. But if you just wanted to take, like, some type of a directional position, it could definitely be done. So take a look, dig a little bit, and try to find some of these ETF products, that's got some good liquidity on them. In fact, what you can also do is, I don't know if you're on ThinkorSwim or not, but you can actually pull up under our public lists like all ETFs, and you can look at triple levered ETFs, and you start to search through some of the ETFs to try to find the one that's right for you, especially when it comes to, currency type ETFs out there.
Okay.
Yeah, hopefully that helps you out. And I'll tell you what, if you feel free to shoot me an email anytime, and I'll try to dig through some of these things to find one that's got a little bit more liquidity for you, because, again, I haven't looked at it in quite a while out there. But, that's another trade that I'm kind of in agreement with you. And tell you, it's rare that I agree with basically every caller. And, somebody said, hey, get short silver. I'm like, I agree with that. I'm going to get short some silver. Then I look at this euro-US dollar, and I'm kicking myself right now for not really having this position on. Because, again, I'm not a huge directional trader, but I like being a contrarian. And this one, again, screams to me the euro-US, get short. It just does. It screams to me get short. And if you've traded any, futures products?
Yeah.
Traded futures before? So there's one other product that you might want to consider. The Chicago Mercantile Exchange has a product that you can basically trade the Euro FX futures, and you can just buy and sell these particular futures here, and it's /6E on the ThinkorSwim platform. It's a symbol worth taking a look at, and that's basically it's a currency future there of the euro. So, yeah, it might be worth looking at to you. If you just wanted to get short without options, you could just sell this product. So, all right, Dennis, thank you very much for giving us a call this afternoon here. All right?
Yeah, thank you.
Thank you. So, that's a great question. Again, getting short seems to be the theme today. So what have we talked about? We talked about getting short silver. We talked about getting short the S&P. We talked about getting short, the euro versus the U.S. dollar. I'm liking it. So, hey, that's the ultimate theme today. If you have a product and you're thinking about getting short, no, I don't care whether you're getting long, short, flat, doesn't matter to me. With that, let's actually go to Bill in Boca Raton, Florida. Bill, you've got a question. Is it ALU? You there, Bill?
Yes, I am. Thank you.
Yeah, sorry to keep you waiting there. So,
that's all right.
ALU. Okay, what's the question on there?
Well, I actually bought the stock at $5.35, and then I bought some May 6s for 20 cents, and of course they're in the money now. But now I'm sitting there going like, okay, this thing really kind of slows down on occasion, consolidates very tightly, which means obviously the call goes more worthless. So I'm wondering, should I take my money now and run with the little profit I've got, or hang in there?
You said the May 6 calls. Is that what you're referring to? The May 6 calls?
Right.
Okay, so those are slightly out of the money still. They're about 12 cents out of the money because right now we're sitting at $5.88. So the market on those May 6 calls is 30 by 35 cents. On a trade like this, just be aware you're going to be burning a lot of premium as this April option starts to burn out. This May option becomes the front month. You're going to start burning premium faster and faster. So if you paid 20 cents for them and you think you might be able to get a decent premium in here, these things are trading in 5-cent increments right now. There's not a huge amount of liquidity. But if you can get out of these things for 30 to 35 cents, you might want to consider it, because as soon as the time premium starts to kick in here, the decay really starts to kick in, I think they're going to eat you alive, on these 6 calls. There's no problem whatsoever with taking the money and running. The other thing you could do is if you own like 10 contracts of these 6 calls, maybe close out a chunk of them. If you're really bullish in this underlying, I hate to get you out of a trade, that you like. But if you're really bullish in here, so keep half on. Take half off and give yourself a little bit of a free ride. See what happens over the next couple of days. But, there's nothing wrong with taking the money and running. That doesn't mean you always take small profits out there, because you always taking small profits, sooner or later you take a large loss. But it just means, be relatively conservative on these profits.
So when would you, let's say I wanted to, let's say I thought the stock would continue to move up. So I take the money here. What is the kind of the the weeks before, the weeks after expiration that you really like to get in, and you're not up against 10 more days, and when do you like to get in? Is there a rule of thumb there?
Yeah, if I get into option strategy positions, especially when I'm selling option premium, I'm getting in anywhere from 4 to about 8 weeks prior to expiration. That's excluding all weeklies. I mean, once in a while, do I ever mess around with weeklies? I do. Weeklies are kind of like, if I've got a little bit of time during the week, I know I'm going to be home to be able to watch this stuff, I'll trade some weeklies. But for the most part, when I'm letting option premium decay in my favor, I enter the trade about 4, but no greater than about 8 weeks out is usually idealistic for the trades I put on. And that's really to give, especially when I'm selling premium, to give myself enough time to get some burn on those options, meaning I want the options to decay, but I don't want to basically sell an option right before expiration because that's where there's a lot of risk, right before that expiration cycle. So I like to sell a little bit of meat, but not too much time out there.
Great.
Kind of a sweet spot. Yeah. Yeah, but
okay.
Again, you bought these 6s, nothing wrong with that whatsoever. Obviously, you were bullish on here, had some pretty good conviction. There's not a lot of money, though, to be made here. And the reason being is, it's a $6 underlying. It moving, 10, 15 cents percentage-wise adds up. It's only going to do that so many days in a row. But what is interesting on this underlying is this underlying has got a pretty serious volatility associated with it. It's a 62% vol on it, which is, it's rocking. For a $6 stock, it's got some pretty serious vol.
Right. Okay, thank you.
Yeah, thanks again for calling us. So got some absolutely great callers. So, hey, Bill from Boca Raton was the first person that we've heard that's bullish today. Yeah. Well, he's bullish, but about to bail out of a bullish position. So I don't know if we're going to call that bullish for much longer. He rode the upside, taking the profits, and you might want to run. I'm actually reading a question here and in the chat, and it says, Don, any option strategy on Apple selling calls in April, assuming 350 cap earnings are April 20th after April option expiration. So let's go to Apple. Ooh, Apple computers. I've never heard of that one before. I have to tell you guys, I'm a pretty big fan of Apple. And when I say a big fan of Apple, I do not trade this underlying. I am not bullish on this underlying by any means, shape, or form. That being said, I really like their products. Okay, so I'm a big fan of the iPhone 4, iPad, Mac computers. I'm actually utilizing a PC today because all of you are utilizing PCs, but I'm a big fan of Apple products. That being said, I don't know. I just can't justify Apple being bigger than, Microsoft. Everybody in the world has got a Microsoft product on them. A lot of people obviously have Apple, but, it's tough. It's tough at this valuation here for me to get excited about getting long Apple. So once again, I told you the theme today is get short, right? So we're talking about basically getting short Apple computers. There's not too much you can do around this. You'll start to see the volatilities picking up in the May expiration, obviously, because there's going to be an earnings announcement. And really straightforward trade is to just go out and to sell like a 350, 355 put spread on here. And I'll bring this up because there's a couple things you could do here that would be interesting. If you wanted to get short Apple, you could sell a 350, 355 call spread for $2 or $2.05 here. The trade is straightforward because that's a $5 wide spread. Collect $2 up front. It's basically got about $3 a risk. All right, and ultimately, okay, the trade has got about a what probability of success? Well, I could do the math behind it, but it's easier just to pull up options, theoreticals, and Greeks. Come to probability of expiring, there's about a 65% probability associated with this particular trade, which is right in line with about risk 3 to be able to make 2. That probability is right in line over there. That's one scenario that you could do. If you wanted to get cute, you could also put a little bit more risk in this trade by widening out the spread. Widening out the spread, basically, what does it do? Now I did 350, 360 spreads, $10 wide spread for a $3.80 credit. Probability is about the same, okay? But this particular trade, the probability is the same, but the max loss, if you do one contract, it's cheap for commissions with one contract, but the max profit's 380, max loss is about 620. Again, has about a 65% probability of success associated with that. Again, not a half bad trade. There's a few other things that you could consider here as well. I'm going to actually, tweak this trade very slightly. For those of you that know your options, here we go. We're going to actually do an unbalanced iron condor on this thing, especially around an earnings announcement. This can be easy. What I'm going to do is I'm going to right-click on the 350 strike, go to sell, all the way down to Iron Condor. What I'm going to do is I'm going to sell a 350, 360 call spread. I sold the 350, 360 call spread, and the put spread, I'm going to roll it out a little bit. I'm going to roll the put spread all the way down to, let's say, the 310, buying, for instance, the 300s. What's interesting about this particular spread is simply it's an Iron Condor. It's a straight, old-fashioned Iron Condor. The reason it's unbalanced is because the call spread that I'm selling, this call spread I'm selling is closer to the underlying price, okay, because I'm only about $9 out of the money. Basically, Apple's at $3.41. I'm selling the 350s, buying the 360s, about $9 out of the money. Plus, what's your break-even point? It's $3.50 plus the $5.36 you collected. So about $3.55 and change is the break-even point to the upside. To the downside, I just pushed the strike out a little bit. So I'm selling the 310s, buying the 300s. I could even go even further. I could sell the 300s, buy the 290s, okay, to make this thing interesting for now $4.85. Hit confirm and send. You can see everything from, of course, break-evens, probabilities associated with it. What I like about this trade is this particular trade, selling a $10 wide spread, but the trade really only has approximately $5.15 of definitive risk. Credit is $4.85. Probability is decent. Earnings come out. If we stay in the range between $3.55 and about $2.95, this trade is profitable. So it's kind of a scenario that you can utilize there. And again, I'm always trying to step it up a notch. So you can go out and you can sell a call spread. If you're bearish, you could go out and sell a put spread if you're bullish. But, the thing I got to point out here, if you're bearish and you sell a call spread, they're going to tie up margin. Okay, they're going to tie up the reduction in buying power here is basically $5.15. But if you additionally sell the put spread, we at ThinkorSwim don't tie up any additional margin. So bottom line is, go for it. You've got to utilize your capital correctly, all right, and effectively. Utilization of capital is absolutely critical. So with that, I know we're kind of coming to the close of the day. We have moved absolutely nowhere on the market since we've been talking. S&P futures are up 3, NASDAQ futures down about 3 1/4 here. Dow futures up 32 on the day. The VIX off pretty good on the day. The VIX now is down to the 16.5 range, okay? So we're looking low volatility. Might be a good time to buy some out of the money put calendars. Keep that in mind, and be sure, give us a call next week when we're on Tuesday, okay, 1 p.m. Eastern Standard Time. Thank you very much. My name is Don Kaufman on behalf of TD Ameritrade, ThinkorSwim, and all of our group over here. Thanks again for joining me for the Options Hour once again. Thanks a lot, guys. Bye-bye.